Hey everyone, it is Ian, and today we're going to be going over another trade idea and introducing a new topic called confidence intervals. I've kind of mentioned this a little bit before, when we were talking about how much conviction or relative confidence that we have in a particular trade can warrant if we put on a condor or a straddle. Today we're going to be going over that a little more in depth and introducing a second topic on top of that, which is sizing. You guys are probably familiar with sizing, but confidence intervals can really affect the overall sizing of your trade. If, for example, if you are not particularly exuberantly confident, like you don't sit here and think that this is surefire, can't miss, easy money in the bank, like an arbitrage, then that's going to affect your sizing, right? If you are basically guaranteed money, you're going to size as much as you can. And if there's a trade where you think this could be profitable, but there is some apparent risks that are taken into account, you're probably going to tone back your sizing. So that's the general concept. And today's example is ticker symbol CZR. This is Caesars Entertainment. They report earnings today after the close on November 1st. So looking at this particular trade here, what we can see, we have a couple of numbers that jump out right away. We have an implied move versus average move of, let me just refresh the data here, sorry. Um, just so that way we have it accurate because it's intraday, so everything's moving. We have an implied move versus average move of 1.95, an implied versus average implied of 1.18. So this indicates to me that, looking at these ratios, we can see that this is particularly expensive relative to its historical implied move, but it's also expensive in terms of its average move. So consistently, what we can see is that this has not been profitable. Its historical straddle P&L is almost negative 194% being long into earnings. And what we can also take away from this is we can see that more times than not, this is pretty much a really solid winner. And when it's been a loser, it hasn't been a ridiculous loser. This isn't like a 200% blowout. This isn't like a four standard deviation, three standard deviation move. And I think a lot of that stems from the fact of just the business model. This isn't like, high yield growth stock. This isn't like a disruptor. This isn't something like, for example, with management risks, right? This isn't like, like a Credit Suisse where they're having, ridiculous issues with their balance sheet, or this isn't like Snapchat where they literally can't get the revenue to grow because no one wants to advertise on their platform anymore. So the fundamentals here are a little bit different. I think that plays a part into why we see this. Now, if we look at the historical call P&L, what we can see is that calls actually do perform they're actually positive slightly, 26.6% return over the past 15-ish quarters or so. And the put P&L is significantly negative, negative 407%. So what we can take away from this and what we can infer about it is that, it's definitely a particular stock with earnings that typically does well, right? They don't go into their quarters. They don't have ridiculous blowouts to the upside usually. They've had good quarters, right? Like they've had really good quarters, but it's not like ridiculous blowouts. And when they have like a subpar quarter, where, they're taking a loss on the earning after the earnings event. It's usually not anything ridiculous, excluding February 25th, which I think, is right around when COVID started to become a thing. I think that probably played a part in that particular performance. So, with that being said, one last thing to go over here with our analysis is the implied move. Now, we've seen the implied move come down a bit. I think in a large part, though, again, this is due to more just overall market volatility. I think that when markets come down, obviously, or when markets calm down a little bit, like we've seen with the SPX rally the past couple of weeks, you begin to see, implied moves begin to come down sometimes as well. And that's typically just due investors are, less afraid of, what the earnings are going to say because for whatever reason, right? So, with that being said, this looks like a pretty profitable trade. It looks like a pretty, not significantly risky trade. Now, obviously, earnings carry a ton of risk, but this isn't like, for example, here, this isn't like Snapchat, right? I know I use this example a lot, but it's really good. This isn't like Snapchat, where we see just ridiculous blowouts. We're talking about implying 20% and it realizes 58, right? Or implies 17 and realizes 39. This isn't like that. Okay. So does that mean that it could happen? Absolutely. I mean, that's why premiums exist on earnings. It can always happen. But I'd much rather would pick a trade on something where the historical odds of that happening are lower than another trade where, the P&L is negative to be short earnings volatility on. So with that being said, we can go over to Thinkorswim and we can begin to price out a trade, right? And this is where confidence intervals come into play. Now I have, relatively speaking, forecast volatility's post earnings event here on the right already. And we're going to walk through these three examples. So first and foremost is just the short straddle, right? Now we've actually seen the options have changed a little bit, but obviously you guys know at the money is what we're going to go with. So if it's at 44.5 heading into the close, then you're going to sell those options. If it was at 45, that's what you would do. And if you were to take this trade, etc. So for this example, we're just going to use the 45s. And what we can see is that obviously we're going to make, a significant amount of money bang for our buck, so to speak, if this doesn't realize a significant move, right? So if it realizes its average move, which would be somewhere around in this range, right? We're going to be making around $185 per bet, right? Now, obviously, there's the risk factor of, blowing out to the top side and to the downside. So our confidence interval, right? How confident we are in this trade being profitable. At the same token, how confident we are since we are taking on this infinite risk to the upside and the downside. Our confidence interval that this isn't going to be a huge blowout should be pretty high as well. So it's really important to understand that part of what I just said, which is there's kind of two ways to look at confidence intervals, right? You can apply a confidence interval to anything. I personally try to apply it to two. What's the likelihood of me getting paid here, and what's the likelihood of me taking a huge loss, right? So if my confidence interval is high that I'm going to get paid, and it's also high that this isn't going to be a huge blowout, then straddles are probably the best bet. Now, if my confidence interval for getting paid is high for making a significant amount of money here, and my confidence interval for this being a huge blowout is lower, then I may consider another structure. But typically, as you guys know, we went over this, right? With condors, is that we're getting paid only $88 here versus straddles where we're getting paid 185, 180. So what you can do instead is tone back the size, right? Now, this is for people with, larger accounts, people that can trade naked options, where you don't need to buy protection. This is something that you can do instead of, placing, like let's say 10 iron condors, right? Instead of 10 straddles, you can just trade, three or four straddles, right? Um, Basically, you want to get it down to where you're probably going to lose this relatively the same amount of money if it does realize your quote unquote worst case scenario. So this is where forecasting comes into play as well. But if my confidence interval was say, you know, like let's say it was like pretty much 100% money in the bank, then you would obviously bet the farm. But if my confidence interval was 50%, you would probably obviously tone back size, but you would still have a pretty good amount of size on it versus like 25%, 10%, etc. Now, the last thing is using the data that we went over, I do want to introduce a different type of structure. It's a one-legged fly. And what this essentially is we are buying, we're buying a call, right? When we're not buying a put. And you're going to notice here that the condor, we're going to get a credit of $2.76. For this one-legged fly, we're going to get a credit of $3.35. So we're getting paid more because we have infinite risk to the downside. But you're probably asking, why would we do this? Right? Well, let's go back here. Let's say my confidence is that this is most likely going to be a profitable trade. Right? Like let's say my thesis is this is most likely going to be a profitable trade being short earnings volatility on. So what we do is we sell a straddle here, 45s. And then if this does realize close to the average move, right? It's most likely, or to the average implied move, or to the implied move, so to speak, it's most likely going to be to the upside, right? And it's probably not going to be to the downside. And historically, these put options do not do well on this particular trade. So let's say my confidence interval on, you know, I'm trying to think of the best way to word this. So let's say my confidence interval for this not realizing a lot of volatility, and if it does, it's not going to be to the downside, was pretty high, right? But I also thought that the probability of this not going to the upside was pretty high, so to speak. So like if I'm sitting here and I'm placing this trade and I'm thinking to myself, okay, this probably isn't going to realize its implied move based off the historical data, but the probability, in my personal opinion, of this realizing that implied move to the upside is significantly higher than the downside. And I think that there's a decent chance of that happening. Then I can put that into my confidence interval and I can structure a trade based around that as well. So that's what this is, right? Because now I'm still saying that, based on my thesis, my confidence interval is extremely high that this put is not going to be profitable. That short side volatility on this earnings trade is not going to be profitable. Then this is something that I'm going to do, right? Because I want exposure to that. I want that risk for that. And I'm mitigating where my confidence interval might be a little bit lower on this particular trade, which is the upside volatility. So what you can see with one-legged flies is that you're going to cap your risk to the upside, right? In this case, we would take a loss to the upside, but it would be a much smaller loss, right? Versus a condor, right? We would take, $124 loss if it realized the significant move to the upside versus this particular trade, the one-legged, where it would only be a $65 loss. Now, obviously, the trade-off to that is the infinite downside risk. So, in essence, confidence intervals are really an output, your personal output for how much conviction you have for a trade based off whatever inputs that you use, right? This could be whatever type of data you like looking at. This can be whatever information you think is valid in terms of analysis. So really, at the end of the day, it is all up to you. But structuring trades and maximizing the structure based off the confidence that you have in those individual scenarios is extremely important. That's what we went over today. So I hope you guys really enjoyed this one. I hope that this kind of makes sense. As always, if you guys have any questions, feel free to message me, and I'll see you guys in the next one. See ya.